Hello, everyone, and welcome to Gold Exposure in 2015 and Beyond, an hour-long webinar hosted by ETF.com and sponsored by State Street Global Advisors. My name is Matt Hogan, and I'm the president of ETF.com and your moderator on today's webinar. I'm extremely pleased to be joined today by David Mazza. David is the Vice President of State Street Global Advisors and the Head of Research for SPDR ETFs and SSGA funds. In this position, David manages a team of product and sales strategists who generate strategic and tactical investment opportunities. In addition, he develops market outlooks and investment themes that integrate SSGA's thought leadership from across different investment disciplines. There's a lot of stuff written in the ETF industry and by ETF industry experts, but I'll actually say David's stuff is some of the first stuff I read each morning. It's consistently good. And today he'll be sharing SSGA's outlook for gold, so I'm excited to hear that. Today's webinar is the fourth session in our 5-part Inside Commodities Week webinar series, a week-long tour of the biggest issues and opportunities facing commodity investors. All of the sessions so far have been great, but I'm particularly excited to host today's session because there's nothing that gets people more riled up and nowhere that there is need for more common sense insights than gold. The format for today's webinar will be simple. The webinar will focus on the outlook for gold and the role it can play in a portfolio. We're going to try to answer questions like, can the gold price recover short-term? Can it recover long-term? How do you determine a fair price for gold? What is the role of gold in today's portfolio? And does gold still retain its promised benefits as a tool for diversification, a hedge against inflation, a tail risk hedge? David will kick things off soon with a 5-minute short presentation giving SSGA's overall outlook for gold at the moment. We'll then jump into an in-depth Q&A where I plan to ask him all the hard questions I've ever dreamed about asking someone about gold. We'll reserve 15 minutes at the end for audience Q&A. All in all, we expect the webinar to run about 50 minutes in total, although we may run over if there are a lot of questions. Before I turn it over to David, however, there are a few bits of housekeeping that I do want to cover. First, I'd like to thank today's sponsor for the webinar, State Street Global Advisors, as well as the other sponsors of Inside Commodities Week, U.S. Commodity Funds, VanEck Market Vectors, and Bloomberg Indexes. Without their support, none of these fabulous webinars would be possible. Secondly, because people always ask, a recording of this presentation and the slides used today will be made available on ETF.com within 24 to 48 hours after this webinar. As a participant in today's webinar, you'll receive an email alerting you when the presentation is available for review. You can also watch any past installments of the Inside Commodities Week on demand by visiting the Inside Commodities Week page on ETF.com. Third, if you're attending this webinar live, you are eligible for continuing education credits. Information on how to apply for those credits will be made available to you by email within 48 hours of the conclusion of this webinar. And finally, we'd like to think of you as a participant in this webinar and not just a listener. You can participate by asking questions. There's a Q&A toggle at the bottom right of your webinar screen, and you can use that to ask questions of David or I anytime during the webinar. Don't wait until the end of the webinar to ask your questions. Ask them as they occur to you. We'll collate the best ones and get to them during the Q&A. Now, I've prepared a few slides that David may speak to, but overall, I'd just like to kick things off by handing it over to David, Vice President for State Street Global Advisors, to give his overall outlook on gold and its role in the portfolio. David?
Matt, thanks for your introduction, and thanks for having me participate in today's webinar. I think, as you mentioned, gold is an asset class, as some would consider, and others, with the recent movement we've seen in price, are questioning its role as an asset class or in the portfolio. And I think what's interesting to do is sometimes take a step back when you have had either the pullbacks that you have mentioned or just frankly from time to time from a portfolio construction standpoint and begin to understand and begin to decompose what really the role of gold and what it's all about. This is an asset that has been used for millennia, for centuries. There's evidence going back to present-day Turkey where there was the first gold coins in the 6th century BC. And so if this is something that's maybe that barbaric or a relic, why is it still relevant either with the advent of gold-backed ETFs and GLD, or just quite simply the fact that gold really is something which is very unique. It's a very, very rare element. It's malleable, but it also has significant durability. It's an inert metal as well, and it's very, very dense, so meaning it has high value in small quantities. Plus, if we think about other types of commodities or other types of investments, it can be quite easy to store and transport. So these are the components or critical elements of what gold is. But when we think about its actual investment demand, what is that made out of? And what role does that play? Because when we think about it, actual demand for gold, either in coins or physical bars or with ETFs, is actually 35% of the broad market. I mean, that's surprising to a lot of investors because we often think of the headline, well, it's all about investors in ETFs or just simply people buying coins. Gold actually has significant jewelry usage. 48%, in fact, comes from jewelry. Another 10% is commodities, and then central banks, of course, are net purchasers of gold at 7%. So this role of gold is used in a variety of different ways. The real other interesting element that I actually like to think about is where geographically does demand come from? And it actually comes from mostly, there's been a major move from Western demand to Eastern demand. And this is really exaggerated last year during the sell-off in gold, where while investment demand was decreasing, particularly in the U.S. and Europe, physical demand was going gangbusters in Greater China and in India. Greater China represents 22%, India 26%. So this is significant demand coming from Asia and coming from the East, which is in some ways being driven by some cultural affinities toward gold, but also being driven by the fact that there is a movement toward appreciating the role that it can play in a portfolio in a very, very broad setting. So as we've seen income increase in those markets, particularly China, it actually has a very, very high positive correlation. So now in total they make up 50% of the world's demand. So we actually expect that could actually continue to be the case. But to get back to what maybe really matters for investors here, I think gold can be quite misunderstood. Certainly it's controversial in a lot of ways. Over the years, and this is an area which I think we can really dive into, is what role should it play? There's proponents that say, well, gold is an inflation hedge. There's proponents that say gold is a hedge against the dollar. Others might simply say it doesn't play a role at all, or quite simply a diversification benefit, or as a tail risk hedge. So there's all these different ideas or opportunities that can come into place of what and why gold might play a role. I personally believe the diversification benefits over the long run are particularly important, and that might be difficult to say because certainly in today's market, many people would say, well, maybe I'm not favoring that much diversification. But if you look either during times of market volatility or quite simply the additive benefits that such a unique asset can bring relative to traditional stocks, bonds, and other commodities is really where a lot of gold benefits can come from. So that to me is over the multi-decade period that what we've seen either in gold's run-up or in times of volatile performance, it has quite a bit of benefits to the overall portfolio. So those are some of the elements that I think play an important role from a longer-term perspective. Certainly there's some more shorter-term drivers that we can get into, but with all that being said, I think we sometimes get very caught up in thinking that gold was just there for the return side. And certainly when you're coming on the back of a significant bull market, that's really what a large driver of interest probably was coming from, just simply the total return perspective. But when one thinks about the volatility reduction from an overall portfolio setting is really where I think a lot of the opportunity can come from a long-term standpoint.
Hugely helpful comments. I definitely want to dig into gold's role in a portfolio and sort of tease out each of those potential benefits and talk about them. But first, I want to back up, as you said. We've seen this huge run up in gold from say 2000 to 2012, give or take. This is a chart of GLD, certainly the largest liquid measure of gold. It's a more or less perfect proxy for the actual price of gold. So we saw that huge run-up, and then we saw a significant drawdown, and I think it's left people confused, right? There's sort of two camps in gold that are extreme. There's the camp that says it has no value, and then there's the camp that says you should always accumulate it regardless of price. Maybe you can speak to, David, what contributed to that significant run-up that we saw in gold? You know, how much of that was fundamental supply and demand, and how much was just performance chasing? What contributed to the pullback? And then let's talk about those short and long-term drivers of gold. But maybe you can just put that price change in context for me and talk about what were the drivers there.
Yeah, definitely a meaty question there, but one I think really worth digging into, because you know what we had seen over the decade, where gold was really just sort of steadily rising, is a big part of that has to do with the fact that globally, there was a change occurring, and one of that changes is what I mentioned earlier, is a move from demand from simply the West, the U.S. and Europe, to Asia. So as the Asian markets have become more liberalized, Shanghai Gold Exchange is just one example of that, or quite simply, the income in those economies has increased. A lot of that has led to a new source of demand, one that really has some persistency to it. Secondarily, you also have the fact that during that time period, central banks moved from being sellers of gold to being net purchasers. That was really exuberated in the late part of the last decade, after they had been sellers through most of the 1990s into the early 2000s, and in some ways fairly aggressive, putting gold onto the market. But what you had seen is, even as the price has come off a little, gold central banks, gold purchases by central banks, remain quite positive. So we have these secular forces at play. Another secular force, which I think is interesting for today's market in particular, has been that central banks or other large investors, and I think this is actually now beginning to bleed into to all the investment community, is appreciating the role that commodities can play in their portfolio, and then secondarily currencies. So gold, it's certainly a commodity because it's taking off the ground, but it has elements of a currency as well because it's a unit of exchange and a store of value. So just that very fact leads to a lot of uniqueness into what that becomes and what role that can play. In the shorter term, I often feel that gold can be driven by more forces that drive the currency markets. Longer term, I think the commodity story, that supply and demand characteristic, plays a role. So some of it was a rethinking of portfolios, moving away from purely dollar-denominated assets. Then you have the impact of the Asian market coupled with central banks around the globe, all that led to some positive forces. One thing which we did see, particularly in the 2011 period, was after S&P has now famously or maybe infamously downgraded the U.S. sovereign debt rating, that exuberated the movement of gold and really put a lot of more momentum-type players into the market. And price definitely was rising a little bit faster than what fundamental demand would really probably say it could or should be, because you have the one thing to bear in mind is over that decade or longer than decade period, you'd say, well, how come there wasn't more gold taken out of the earth, or how come supply seemed to be so fixed? It's because some of it has to do with extraction costs. Others of it has to do with the hedging that was occurring in the market. But really, a lot of it has to do with that it's quite difficult to find new sources of gold. There hasn't necessarily been the technological innovations like we've seen in the oil and natural gas market, which has really been a driver of oil price increases, and now seemingly is a headwind. So you have somewhat fixed supply plus this increasing increasing demand and diversification of demand, that was really one of the main drivers. In the nearer term, you had more of the influence of, I think, momentum type movers, either on the retail side or in the hedge fund community, that was looking to take advantage of an asset that had seemingly consistently strong performance on a risk-adjusted basis. That came off in 2013 when there was a confluence of events that drove the price down. And now gold seems to be, if we look at just purely the supply and demand characteristics, in a much healthier place from that perspective, from really the individuals or institutions that are transacting in it, with that mix between 50% jewelry demand, then also demand from the investment community. So I think the market's been shaken out a little bit, and what that has done is now opened up potential new opportunities from a long-run entry point. And what we have seen is somewhat of a sea change of appreciation for gold, to be a little bit less of just thinking only about that return side, as I mentioned, and more about the overall role in a portfolio.
Yeah, absolutely. I have like 6 follow-up questions. Maybe we can hit them each quickly, and then we can get to that portfolio row, if that makes sense. I think your comment about the emerging markets is huge, right? As you said, over 50% of demand from China and India. Certainly the sort of stabilization of gold right now is in part because India is in its gold buying season right now, and it's done hugely well. It's a big season this year. Maybe talk about what we can expect from emerging markets demand in various scenarios. You know, if China has a rough landing, will that hurt demand, or is it driven by, you know, more fundamental trends on income? Similarly, India, you know, how correlated to emerging market economic growth is the price of gold at this point?
Yeah, no, that's a really interesting question, because the first approach that we want to think about is separating a little bit of the central bank side and individual purchases. Because the central bank side, certainly a lot of that has been driven by Asian central banks, and really more emerging market central banks, both in Latin America and in other cases, where there seemingly is some persistency there. Because regardless of the price performance of euros or the U.S. dollar, there's an appreciation that we need to have diversification away from assets that are driven just simply by the dollar. So there's some over-concentration there. The dollar has been a lot stronger than what many people's expectations were, and I think that is acting as a headwind for gold in the near term. But one, regardless of price performance, there's going to be demand there. To really get to the meat of your question, though, I think this goes back to demand from more individuals. And this is an area that I think in some ways the playbook is being written on, because there's certainly the potential for a shock and concern of a hard landing in China and what impact that might have. That's not our firm's base case at State Street, but it's definitely one of our biggest risks. We still think that the slowdown in Europe, the deflationary scenario, and that what that impact of long-run deleveraging could have on the global economy as our largest bear-type scenario. The other scenario that we are certainly taking a look at is in a hard landing in China. And the longer-run perspective is actually driven by the income side. So gold is an asset that has elements that are cyclical in nature and defensive in nature, which is quite unique. So on the defensive side is actually when you see greater investment demand. So when risky assets, equities, credit is underperforming, you tend to see money move into gold to serve as a buffer and a ballast in portfolios. Conversely, when times are actually doing well and economies are expanding, the jewelry part of gold tends to play a larger role. And when you have both of those elements working together is when you actually end up with, and sometimes there's counter-cyclical forces almost fighting each other, and you just put up a great chart talking about the net demand for gold, particularly on a quarter-by-quarter basis, to see some of this evolution that we've seen. This holds true over multiple periods. So if if China does continue to expand, even in a soft landing type scenario, at 7.5, maybe actually that's 7% growth, incomes will continue to rise there. And as incomes rise, there will be increased demand for jewelry and increased demand for goods associated with gold. A hard landing scenario, I think, was beginning to be looked at and analyzed by the market, and that's sometimes when you can see a spike or a sell-off, I should say. But it's one that I think investors need to consider, but it's not one that we think is worth being priced in significantly. The larger headwinds, which we of course we can talk about in greater detail, is simply I think the market does not fully appreciate actually the role that the Eastern market plays. The investment market doesn't fully appreciate that, and oftentimes we're overly focused on the Federal Reserve and quantitative easing and things of that nature. Certainly that plays a role. The Federal Reserve's policy will play a role in what impact that might have on the dollar, but the bigger knock-on effects in today's market are really being driven by that jewelry and on the Asian demand side.
Yeah, I think it's a remarkable piece of the gold story, actually. Even for gold skeptics, is that tie to the Asian consumer, because it is such a dramatic piece of the demand profile. It's not what we think about, as you said, but it is such an enormous piece. I do want to drill down a little bit on one of the other drivers you mentioned, which is the central bank purchases. Certainly a sea change from 10 years ago when there were significant sales. I guess my question there again is there a geographical bias there? Are we talking about Western central banks buying gold, the U.S., Germany? Are we talking about China? Who is responsible for what's becoming a significant driver of demand?
A lot of it has to do with the emerging markets. So China is definitely a player there. Certainly the statistics out of China are one that some investors care not to rely significantly on because some of the information is not as transparent. But we one day could wake up and China could make an announcement that they have purchased an exuberant amount of gold slowly but surely. The other part to play a role, it's less on the U.S. and on the traditional European side, but there are pockets, and we hear rumors and some of the votes that are going on in Switzerland, which again we don't think are a base case type scenario, but that there might be further demand for gold from developed market central banks. A lot of it really has to do with the fact that most central banks in the emerging markets have an over-concentration of dollars and to a lesser extent euros in their portfolio. And while that makes sense because of the role that the U.S. economy plays from a GDP standpoint, many are concerned about what that undue risk could do to their reserves. So they are actually thinking about gold as a currency hedge in their portfolios away from just pure U.S. dollar exposure. The other element, which gets into somewhat of a controversial type standpoint, is just simply the role that fiat currencies can play in a portfolio. We've been really concerned about what could happen if you have a runaway inflationary type environment. Now, I actually am personally less concerned about the potential for that, just because we have had such a limited velocity of money here in the U.S. and simply that it remains paramount in Europe. But many emerging markets don't necessarily want to wait for that to be the case, so they'd rather begin to build their diversification now and be less subject to the whims of either central bank policy that they cannot control, considering that we saw around the taper tantrum and some of the impact that had on twin deficit countries in the emerging markets. They want to bolster their reserves. They want to be in a stronger position and really diversify away from just simply U.S. dollar risk.
Yep. Yeah, we're definitely seeing that. And certainly some individuals, I read Jared Dillon the other day who said you should be your own central bank and carve out a portion of your portfolio for gold. I do want to talk about the U.S. dollar and then about short-term trends, and then we'll go into the portfolio question because I think we've done a great job talking about the long-term drivers, emerging markets demand, that new central bank demand. the criticality of the Indian and Chinese consumers. Certainly the U.S. dollar and its influence on the price of gold is significant. I've put up a chart of the U.S. dollar index's 3-year returns. It shows the strong move in the dollar recently. I guess talk a little bit about SSGA's outlook for the dollar, and then generally how investors should think about the interaction between dollar strength or weakness and gold prices.
I know that again is another interesting element to begin to think about, because there's really a few camps out there in the dollar, and I think folks within State Street are on other sides of this, are on various sides of this. There are many that have been calling for a very significantly strong dollar for the past few years. Others out there, believe the U.S. dollar is going to hell in a handbasket, if you will. Now, I think the reality is that we're somewhere between the two when push comes to shove. But what we really need to think about, particularly when it comes to currency markets, is the cycles in currencies are very long. They're longer than business cycles. So the bottoming or basing of a particular currency relative to each other, or here you're showing a broad-based basket, can take a multi-year period, really. And I think that's what we had probably begun to see with some of that choppiness in performance from really what we're showing here from 2012 to the middle part of 2014. It hasn't been until we've really begun to see divergence in monetary policy. Divergence in monetary policy has sort of become a consensus-type trade, because we know on one hand we have the Federal Reserve ended quantitative easing, most likely, barring any significant setbacks in economic growth, will be raising administered rates, probably in the back half of 2015. On the other hand, you have the Bank of Japan just really, really wanting to engage in significant amount of extraordinary monetary policy, recognizing the fiscal situation in Japan is ugly, the impact that their consumption, their VAT tax had on really setting back their economy. They're actually front-running weaker economic growth by doing all of this quantitative easing on an economy that's really only the third of the size of the U.S. Then you have the ECB, which has been all talk and no action in reality. And certainly there has been some reaction there, more acronyms that most people would want to remember in a lifetime, but the potential is there. The bazooka, as Draghi famously said, if they do engage in it, I think we better watch out. And so that's finally which has been the driver for the dollar to begin to see this strengthening cycle. And one of the there are a few drivers of gold over the medium toward the short to medium period. Importantly, one of them has to do with inflation expectations. Inflation expectations in the U.S. And then globally play a role. One of them is the dollar, as we're talking about here. Others are geopolitical risks, which is difficult to model. Another is just the performance of other assets, particularly how the equity and more risky assets are doing. But over the short term, the role of the dollar can really play an outside role in pushing up the price of gold up or down. Over the long run, the fundamental picture rules the day for the performance of gold, so the demand relative to the supply. But in the short term, what we often see is that gold behaving like a currency. And right now it's behaving like a contra currency to the U.S. dollar. And as the USD has begun to have this strengthening type cycle, we've seen that seemingly has been one of the largest drivers of some of the renewed weakness in the price of gold. Now, what's interesting, though, is that the conversations that we're beginning to have, particularly with institutional clients who are always sort of looking for information and looking for best ideas, is saying, appreciating that the dollar might actually be in this kind of longer-term strengthening cycle, but again, looking to potentially take advantage of when is that gold weakness create a buying opportunity for them, which will be a further source of investment demand. So it's becoming somewhat of a wait-and-see type approach for clients of that nature, but they're really actually beginning to want to understand that the element that the influence of the dollar, influence of inflation expectations, and why gold might be a buffer to, on the other hand, the potential for volatility to reignite within the currency and equity markets, and that's really what's not being significantly priced in.
Right. Yeah. I mean, certainly in our own Alpha think tank recently, we've had both Peter Schiff and Mark Faber talk about increasing volatility in the core currency markets and gold as a hedge for that. So I'm not surprised institutions are talking about that. And gold's held up, relatively well considering the recent run up in the dollar. I do want to ask one more short-term question about gold's price direction. Then I do want to ask you portfolio questions and where it fits. But my short term, we've seen a lot of actually disparate calls on gold recently. We've seen negative calls from Credit Suisse, positive calls from others. Certainly you mentioned about how, a lot of momentum players came into the market. What have you been seeing recently in terms of flows into GLD, which is sort of the proxy? It's the easiest way for momentum players to enter or exit the market. There's certainly a lot of long-term fundamental holders there as well. But what have you seen in terms of flows into the product, over a 3-year period, but then perhaps more interestingly over the last couple of months?
Yeah, no, so certainly the flows into GLD are really indicative of somewhat of the overall sentiment for gold demand, particularly on the investment side, because when GLD came to market 10 years ago, it did democratize gold investing. It did allow for investors, both large and small, to express an opinion, both positively and negatively, on the price performance of gold. And what we had seen to start the year is that there was renewed interest and renewed inflows into gold back into ETFs and GLD in particular. More recently, as the dollar has been on this uptrend and gold's performance has been, I think, as you mentioned, has actually held up relative to probably what one would assume would be the case. To be, I'd say, more two-way flow, so inflows and outflows, kind of depending upon what that price performance is. So it's definitely an indicator that I think gives us some real-time sentiment, the shares outstanding of GLD and other gold-backed ETFs. But by focusing too much on that, we sometimes can ignore that only actually represents about 7 to 10% of gold demand on any given year. So definitely gives us an early read, but peeling back the onion and understanding the other drivers, I think, is one that we like to try to do as well.
Right. All right, so I'm reasonably convinced there's a good case for the long-term demand in gold, perhaps even outstripping supply. That emerging market story, I think, is pretty powerful. But let's imagine I don't own any gold in my portfolio. So starting anew, just convince me that I should, and then I'll ask some specific questions about, the key benefits it's going to offer me when I add it to my portfolio.
Yeah, so you're asking a few different questions there, and all of them are important. When I'm thinking about portfolio construction, and I get to spend quite a bit of time engaging with all of our different products on the equity side and on the fixed income side, and with GLD and some of our other multi-asset type products. I'm really thinking more and more about correlation, and correlation matters, and everyone focus on it. But I'm less concerned about just correlation matrices, and more concerned about rolling correlations and correlations during different time periods. And this is not just saying, well, correlations go to one and down markets. It's saying what type of market environments and historical performance is not indicative of future results, but it can generally tell us about what you might come or expect to see in different time periods. So what we find is that when you put gold next to other traditional assets, stocks and bonds, quite simply, or even breaking it down into REITs, other types of commodities, it's because its demand drivers are so unique, because you have that balance of technology, investment, central bank, and jewelry. It has the ability to perform very differently than stocks or bonds. That low correlation is, in my opinion, the real main driver of why gold deserves a role in a portfolio. There's been studies by a variety of different firms, both academics and practitioners, who have generally found that somewhere between 2 and 10% of gold is beneficial to the portfolio. Some of that has to do with the risk that the portfolio runs at. So actually more equities in a portfolio, you benefit by having more gold. If you have a more fixed income heavy portfolio, gold actually increases the volatility, although it has those diversification benefits. So to me, it's something which is a standalone asset. Most traditional commodity indices do not have a significantly large portion of gold in them. And when you stack gold up next to other precious metals, where the correlation, of course, is higher, particularly to silver, but silver is much more volatile than gold, is when you begin to see those benefits. So I think gold is an asset that deserves a role in a portfolio through good times and bad, and it's about dialing up or down that exposure depending upon what anyone's expectations might be of things like the dollar, things like inflation expectations, things like the potential for renewed volatility in the equity markets, which has certainly not been the case this year, is when we might want to think about dialing up or down that exposure.
So if I'm starting from a position of zero gold, let's say I have a 60-40 portfolio, globally diversified equities, core bond exposure, and I want to move to 10% gold, where do I take that 10%? Which side of the ledger?
Yeah, that's a really important question. But I think probably for a portfolio of that nature, I would most likely probably take some of that, more of it from the commodity side. From the equity side. Although you could simply figure that math out depending upon how volatile your fixed income portfolio is. And this is something which I think is quite unique and beneficial for gold. Is, as we know, with all the concerns about rising interest rates, a lot of investors have moved away from traditional fixed income with all the duration risk that it comes with, and moved into more credit-sensitive instruments. They have a lot of benefits. They increase yield. They lower duration. They actually have some diversification benefits. But one thing that they do is that they have higher correlation to equity markets. And that, I think, it's not misunderstood, but it's often not discussed quite a bit because we're so concerned about treasuries, so concerned about the long bond and all of that. I share some of those same concerns, but in today's market, we actually might want to think about funding from the fixed income side of the portfolio as well, depending upon what that fixed income portion of the portfolio looks like.
Right. So as I ratchet up my my credit risk and my correlations on fixed income, you can ratchet back that diversification benefit by taking some of that into gold. Is that that's the core idea?
Correct.
Yep, that's interesting. Now let me try to poke holes in some of the perceived benefits of gold, because these are certainly questions that people ask, and you can tell me why I'm wrong. So certainly one of the core benefits people mention about gold is that inflation hedge, right? That's been its sort of go-to definition for years, maybe millennium. But its biggest run-up came during a period of extremely low inflation. So make those two line up. Is it still a good hedge against inflation, given that it had that extraordinary run during a period where inflation was a couple of %?
Yeah, no, I think it broadly is, and the reason being is that inflation is not the only driver of the price performance of gold in the near term. It's an important one. I would say, based off of the research that I've done, that price of the dollar is the most important, secondly followed by inflation, really inflation expectations. So one of the more recent run-ups that we saw is that because of the increase in the balance sheet of the Federal Reserve, just exponentially with quantitative easing, Operation Twist, that many people were saying, okay, well now's the time we're going to start seeing inflation. It's going to have to. All this money printing must lead to inflation, and those are theorems which have some relevance, particularly from going back to Milton Friedman. But the problem is, if you don't have velocity, if you don't have money moving around the system, you can print as much as you want. The velocity of M2 has, from a ratio perspective, moved from 2.2 in the late 90s to now one of the lowest levels on record, which right about 1.5. So while we've had all this printing, money hasn't actually moved into the system. So there hasn't been inflation, there hasn't been wage growth, there hasn't been pressures on that. I think many people are still calling for that, that we're going to have this broadly inflationary environment. I personally, we might see lower inflation for longer, just as we might see lower interest rates for longer than many people have been anticipating. But the benefit will come is if you have an environment where inflation is expanding tremendously, which is then bleeding into making it more expensive and more costly and hurting profit margins on the equity side, is actually when you'd start to see the benefits. So it's all about that relative type impact. Looking at just at it in isolation that may not help significantly.
Great answer. Okay, next attempt to poke a hole in gold and see how you do. A big argument certainly for gold is that diversification benefit and that downside risk, right? People want to own gold for when things get really bad. But in 2008, when things got really bad, we certainly saw gold sell off as well. So is that downside protection benefit still real, or what did we learn from that 2008 sell-off that gives us a lesson to remember going forward?
Yeah, so that's definitely an area where you could just point to that one time period and say that and that gold did sell off, and it did coincide sort of with the Lehman Brothers bankruptcy, but actually, broadly in the Great Recession, gold did very well. When the VIX was jumping, gold's return on a relative basis to the S&P 500 was extreme. Where the stock market underperformed and gold did well. If we look at other periods of crises, the flare-up in the sovereign debt crisis, gold outperformed equities. If we look at the difficult period in the markets around 9/11, if we look at the long-term capital management, Black Monday, gold has a record of being that volatility hedge when markets get difficult. But it really comes back to why are markets going through these periods. Some of the reason why we saw that underperformance of gold in 2008 was because it was a global economic slowdown that would have the ability to impact demand for jewelry, demand for investment. It wasn't until we started moving out of that period where we started seeing that counter-cyclical force of investment increasing. And then one of the reasons why I think we saw probably to an overextension when the S&P downgraded the U.S., why so much money moved into gold because they really wanted to serve as that potential hedge from that scenario. Looking into the future, and of course no one has a crystal ball, I think we need to prepare portfolios for more spikes in volatility, not just coming from the equity market. I think there's going to be much more spikes in volatility from currencies, spikes coming from the rates market, which will bleed into equities. We have seen geopolitical risk was pretty hot this year. It's settled down a little bit now heading into the holiday season. Certainly every day on the news, though, if you were to get caught up on it, the situation remains quite scary with Ebola and ISIS and Russia and Ukraine, and then forget about anything that's going on in Southeast Asia. But it's generally less hot than it was. What it might actually start emanating is that risks that stem from various sources of the globe will start having a broader impact on the performance of risky assets. If we continue on this path of divergence monetary policy and the geopolitical side of the house, if there's no real fiscal movement in certain areas is when we could start seeing that spill over. So it's something that needs to be considered and prepared for, although it's not necessarily one that it's very difficult to try to identify ex ante where those hot button issues could emanate from.
No, it's great. Great answer. Yeah, great answer about downside protection and the increasing risk in the world. Certainly a cheaper hedge than owning VIX for sure. I have one more question, then we're going to turn to some questions for the audience. I'd remind people to ask questions using the Q&A toggle at the bottom right-hand side of the screen. Certainly, as you've heard, David is an expert on the global markets and on gold specifically, so feel free to ask him any questions that you'd like. David, my last core question to you is focused on GLD and the various ways you can own gold. So if we've covered, the outlook, supply demand, we've covered gold's role in a portfolio. The question is the best way to own it. So people have a couple choices: ETFs, physical holdings, futures, gold mining stocks. Maybe you can quickly give me the pros and cons of each of those four distinct options in a way that people could make, an easy decision.
Yeah, so like any other investment, the due diligence side of owning particular instruments has only increased as more options have come into the market, which is generally beneficial. But it makes someone's jobs harder because you now have more choices and need to dig through them. I'll start with gold mining stocks. That's a very distinct proposition. So owning gold outright, either via an ETF or with bars and coins, is going to lead to a very, very different return path. So certainly gold and commodities broadly have a correlation to commodity-producing equities or particular gold miners. But at the end of the day, and we're seeing this in today's market, the beta to the S&P 500 or to the equity market trumps anything that comes from its role as a commodity producer or miner. The other question has to do with if we're thinking just simply about owning physical gold or gold in a portfolio. One of the real benefits I think that ETFs have brought is that they fit in an investment portfolio, in a brokerage account, if we just think about that quite simply. So we can see how an ETF is moving relative to other ETFs, mutual funds, stocks, or individual stocks and bonds. When we own gold in other places, and maybe there's an idea that we either have such a significant amount of wealth in gold itself, or we want to feel it. We want to be able to run through the night with it, if you will. You certainly can make a case for bars and coins, but it's very, very costly to potentially to store them. It's costly to actually engage with them because of commissions and things of that nature, which are a lot less transparent with the ETF itself. So the ETF is not the only solution. I think it has a lot of benefits, particularly when it comes to the liquidity, the transparency, and just the efficiency that it can bring a gold investor.
Mm-hmm. That's absolutely right. A few more questions on gold miners specifically, or on GLD taxation. Maybe quickly cover the taxation of GLD and talk about if there are any, tax mitigation strategies, asset location strategies, or if that's just part of owning gold.
Yeah, so gold-backed ETFs, GLD in particular, it's taxed as a collectible, which is consistent to how owning gold outright would be taxed. One of the other things that we can think about with owning a gold-backed ETF is for the right investor. For an investor with the sophistication in the portfolio, we can engage with some options type strategies on a gold-backed ETF, which has the ability to maybe generate some income out of gold. So there's some options there. Anything the tax benefits or things of that nature, it's going to be investor specific, but it's somewhat difficult to get around the fact that the IRS treatment, unless there was some significant movement of there to change that.
Right, but to be clear, it's no worse or better than owning a Krugerrand or a bar of gold.
That's correct.
Right, same identical treatment. One more question on gold miners from the audience. Certainly gold mining executives you would think would know a lot about the price of gold. Oddly, they had all hedged their books when gold was 200, and they rolled off all those hedges up to the point that gold peaked. I guess the core question is, why were they so bad at managing their hedge book, and what is the outlook for hedging in the future, if you know?
Yeah, so it's difficult to decompose the behavior of CEOs or CFOs in the gold industry, or frankly in any industry. And we were doing this presentation talking about refinancing of debt that occurred in 2013 and 2014. We might be having that same conversation a decade from now, which we're seeing them engage in. Same questions about capital expenditures or engaging in mergers or acquisitions. I think what we saw with that period was that is that when you're coming off of such a low base and with expectations were not very robust, it made people probably make decisions that in retrospect that they were hesitant to do. Looking ahead is where we actually might see some interesting behaviors, because generally where gold's price is, depending upon whose statistics you're looking at, we're right around somewhat break-even for production point of view. So one could argue that that maybe you'd want to be able to try to, if we think that there's value in the price, begin to ramp up production, or if they believe that there's going to be further decreases in price, we might see some hedging again, and then that actually could provide some further misbehavior and some further negative headwinds into the price of gold mining stocks if we start seeing gold's continued basing here and then potential recovery.
It'll certainly be interesting to watch. I'd remind people we've hit that 50-minute mark where we were estimating this webinar would run. If you would like to ask a question, one more chance to shoot it in to David Mazza using the Q&A toggle on your screen. I guess my closing question while we wait for those last questions to come in, David, we've covered a great deal of ground. I'd ask you just to make one more concise 2-minute case for why, I, Matt Hogan, should add gold to my portfolio and what I can expect from the long-term price of gold, given the supply-demand picture that you see from SSGA.
Yeah, so happy to make that case for you, Matt, and we'll see if we can make you a believer or see if you're going to increase your allocation after that. So time will tell. But really, when we think about gold, we need to understand that it's a unique asset. And it's a unique asset because it has very differentiated demand characteristics. 50% jewelry, which tends to be more cyclical in nature, significant 35% portion from investment, the remainder from technology and central banks. We also, when we have that uniqueness, when we compare it to other asset classes, traditional stocks, bonds, has very, very different performance characteristics. So when we're thinking about our overall portfolio, obviously we want to always be shooting the lights out with a return standpoint, beating our peers, but we also want asset classes that are resilient to various market environments, and think about how they perform not just in isolation but relative to each other. When we add gold to a portfolio at a modest amount, even between 2 and 10%, we tend to see that we have higher risk-adjusted returns, meaning we're increasing performance without taking on excess amount of risk. Looking ahead, in the short term, gold might face some headwinds from a continued strong dollar and decreasing inflation expectations. However, when we start thinking about 2015 and start thinking about how far equities have come and where multiples are, we're probably going to start wanting to look for solutions in a portfolio that continue to benefit from a improving global economy, particularly as the growth of China and India with the reforms that they're having there will do, but maybe do so in a way without taking on significant amount of risk in the portfolio, as we've seen a great amount of flows into equities and then into credit-type instruments, which have, as I mentioned earlier, which come with a very, very different risk profile than traditional fixed income assets.
That is a great comment. We did have one last-minute question, which I would like to answer, hear your answer, and then I'll wrap things up. You did touch on this a little bit earlier, but how should an investor consider gold versus a diversified commodity portfolio? Are they two separate sleeves, each with a role, or does gold, or are they part of the same idea?
So I'm beginning to see a trend, and broadly I'm a believer in sort of outcome-oriented investing, and I would put gold and commodities into a similar bucket from that standpoint, but I would carve out a distinct portion of the portfolio for gold itself, because by owning just a broad-based basket of commodities, you don't have enough influence of gold because its portion of indices tends to be quite small for it to give those benefits that you can get from a standalone allocation. So they're broadly similar, but we're not going to get enough gold in the portfolio just with that broad-based allocation. I think commodities play a strong role in portfolios from a diversification standpoint. One of the things that we have seen both on the gold side and on the traditional commodity side is as performance has not been as strong as many people had hoped, people have really reduced positions there. If we're thinking about inflation or thinking about dollar hedging or thinking about the multitude of roles, tail risk hedging, you often want to buy that insurance before the house is on fire. So the time to access allocations that can be beneficial in that regard is sooner than later. So we tend to want to take advantage of being contrarian and being early to really gain those benefits.
All right. With that, David, I would like to thank you for taking this hour to speak to us and to all the listeners on the line. I think it was a great talk. Every time I spend time chatting with you or studying the research on gold, I become that much more convinced of its role in a portfolio for all the reasons we've covered today. So I would like to thank all the attendees for attending today. As mentioned, you will receive an email containing information on how to hear a replay of this webinar and to download the slides that David and I used today. That email will also contain information on how to register for the CE credits that you receive for today's educational webinar. There is one more webinar in the Inside Commodities Week. That's up tomorrow on MLPs with our own Paul Britt. It will be a spectacular introduction and overview to MLPs. So if you're interested in that asset class, make sure that you attend. I'd like to thank the sponsor of today's webinar, State Street Global Advisors. If you would want more information on State Street SSGA in general, feel free to go to the spiders.com website. Great information there about all portfolio allocation questions, including gold. I'm sure David would be happy to take your questions from there as well. So thanks again, David. Thanks to our sponsor, SSGA. Thanks to all the attendees who listened in today. I thoroughly enjoyed it. Have a great rest of your day.